Hi, this is ProACT Sam. Welcome to this episode of Living and Working Abroad show. We're discussing today the Halloween budget. It's coming up to winter and we've got a Halloween tax deadline in Cyprus for Cyprus expats, but also we've got a Halloween budget in the UK which threatens with the new government to introduce a radical change to the tax system, which could well see a few rises. We want to anticipate that and consider that in a bit more detail today. So thanks a lot for listening. If you want to contact us at proactpartnership.com, where you can book a free review if you're a new client, or book an advice review if you want some update on advice, reports and returns for expats living and working abroad. So thanks very much for listening, and let's crack on. So the Halloween budget is coming up, and what we want to do is try and anticipate what some of the changes are going to be, and what preparation you could possibly take. Now, when the budget changes, they've got two options. They could announce that they're going to change the tax in the future, in future tax years. They can announce they're going to make the change from the end of the tax year into the start of the new UK tax year on the 6th of April 25, or they could announce the changes straight away. They could even make them retrospective. There are instances and precedents for them doing that. For example, if you're self-employed, all your earnings is deemed to be earned on the last day of the UK tax year, the 5th of April. So you can make a change now that could apply to self-employed people and make it retrospective. They could apply it retrospectively to a capital gain that's not accessible in the return until the 5th of April 25. But that's pure speculation on my part, and let's see what the Halloween budget will bring. So first of all, let's have a look at how it could affect expats in terms of worldwide income. At the moment, if you're non-resident to the UK, then you get large concessions and your tax can be charged locally at the tax rate of the country in which you're in. Now, if you're living in a high tax country, that's no great thanks. But if you're living in a low tax country, that gives you a substantially different position to manage and look out for. So it's something to consider. When you consider if you're an American expat, for example, there's a limit to the amount of income, your worldwide income, you can have taxed abroad. So there's a precedent there with America, the biggest economy in the world, that you could follow that pattern and limit the amount of income and gains that could be taxed abroad. In America, it's $120,000 at the moment. So maximum can be taxed under a double taxation treaty outside the USA. But even so, already the UK have got government service pensions, property rental income, and capital gains arising in the UK as fixed capital gains in the UK, fixed incomes in the UK. So even if you're not resident for income tax, you could still be resident for other taxes. And the tax system, you've got all the Schedule D, Schedule K, Schedule M, L, all these different codes gives us scope to put in some complexity or simplification of the tax system to roll the things all together. So that's a potential issue there. Consider, for example, dividends and interest. They're movable income. If the UK changed their law so that the dividends and interest is not a movable income, it would have no material effect on the double taxation treaty that you have with a country abroad. So if you're in a country where your dividend tax is 5%, and that's the amount of tax you pay on your dividends at the moment. So if you're in a country where your dividend tax is 5% and you're living in that country, that's your dividends received are taxed in your country of residence at 5%, but you're not paying any tax in the UK. Dividend tax in the UK for a basic rate taxpayer at the moment is over 8%, 8.75%. So if the dividend tax was fixed to the UK, you pay the 8.75% tax in the UK. The 5% tax in your country of residence would be part of that 8.75% under the double taxation treaty. So your country of tax resident wouldn't lose out under the double taxation treaty that the UK have already got, and therefore it's very easy for them to make that change without impacting the reciprocal tax agreement they've got with the other country. The people that were impacted were the UK expat, who would have to pay the highest marginal rate, which could be the UK. It's got a reverse impact as well. If you're living in a country where the dividend tax is 33%, you're paying 33% in your country of tax residence, and the UK tax it at source and take 8.75%, well then obviously you're still going to have to pay the difference, but you wouldn't have to pay the 8.75% twice. You don't have to pay the 33%. So I'm deliberately using the UK rates there just to illustrate how it is. So the double taxation treaties are not affected if the UK changed the status of a tax, and it could be the income for dividends or interest or any other type of income could be taxed at source first in the UK. The tax is still paid under the double taxation treaty to a country of tax resident, but you pay the highest rate. If the highest rate is the UK rate, you can pay more, because dividend taxes go up to 37%, income taxes go up to 45%, and inheritance taxes are 40%. So potentially quite a big impact that could be had with some simple changes. And don't forget as well that already, if you're on if you've got a government pension, a government sourced pension, not the state pension, but from a civil service job or government funded pension job, then that pension at the moment is taxed in the UK automatically. So from January 25, all those pensions are taxed at source in the UK, despite where you are tax resident. So that could easily be changed to all pensions, for example. So instead of a private pension being able to be taxed in your country of residence, for example, an expat in Cyprus can pay 5% tax on their pensions. If it was taxed at source in the UK, you'd be paying up to 45% tax. Cyprus would still get their 5%. You wouldn't pay more than the UK rate, but you'd pay the highest marginal UK rate depending on your pension. And obviously, if you've got a pension over 125,000, that's 45% tax in the UK. If it's over 50,000, you're paying 40% tax in the UK. And if it's over 12,500, then you're paying 20% tax in the UK. So pensions and income taxes can have quite a big impact. So for more help and guidance on managing your tax as a UK expat in the UK or outside the UK, to consider the advice you need before and after the Halloween budget, you can contact us at ProACTpartnership.com. We touched on pensions there. Again, it's all speculation at the moment, but there's been lots of changes and attacks on pension funds over the last few years. The deal is that people over their 40-year working career would save money into a pension, get tax reduction on the money going in, get tax-free growth on that pension fund, and then receive taxable income coming out with a tax-free bonus at the start as a tax-free lump sum. So there's a case to be made that we're going to remove that tax-free lump sum. Doesn't stop you drawing the 25%, but now you're going to have to pay 20% or 40% or the high rate tax, or maybe a lower rate tax as a concession. But that would complicate it, whereas I think they're more likely to simplify things at the moment, just have flat rates. So if they're going to tax the tax-free lump sum, it will be just as an income tax. So up to 50,000 you'd pay 20%, and over that you'd pay 40% or 45%. So that's a potential threat, and it will be a change, but the changes have come as we've gone along. Over 15 years ago they started taxing pension funds. So a pension used to grow tax-free, and although you don't see it, the pension fund is now taxed. So it's paying dividend taxes, it's paying interest taxes, it's paying some capital gains taxes within the pension fund. But it's a big block of money and a cash-rich government that wants to buy out private companies in water, transport and energy. Needs to get its capital from somewhere and its reserves from somewhere, and the pension funds are ripe for that, and potentially to increase their tax take as well. The more money you've got that's taxable in the pension fund, the more tax they're going to receive as they go on. And then when you die, think about inheritance tax. At the moment, in certain circumstances, there can be a death duty on pension taxes introduced in the last 5 years. Now that could be extended. Why is a pension fund inheritance tax free? That potentially a pension fund of 1, 2, 3, 4, 5 million could go to a family inheritance tax free when they aren't supposedly the beneficiary of that income in the retirement. We've already seen with the Labour government that they're happy to attack pensioners, so why not attack that income? It's not working people, it's people that retired and dependent upon fixed income and pensions for their income. So there's a potential source there. So at the moment, it'd be very easy to say that a pension capital that's being left to a beneficiary would suffer from inheritance tax. If you buy an annuity with your pension fund, because we're talking about money purchase funds, we're talking about invested pensions. If you buy an annuity with your pension, that guarantees you an income, and potentially an indexed income, and potentially an indexed income with a spouse, a widow's pension attached to it. So, but when you get that annuity, when you die, that money dies with you. But the money doesn't stay with the pension company. The pension company pay a tax, and some of that annuity fund goes back to the government. So it'd just be a matter of extending the approach that they've got with annuity pension funds on death into money purchase pension schemes. So the flexibility, the independence that they gave you is being removed, in that it's your money that you earned, but the government are more equal and have got preferential rights to decide what they do with your money that you've saved and earned all your life to do. And why should your children benefit? They could just go on and they could do their own work and start from scratch. Isn't that the way it's done? Anyway, rowing back from that political point, pension funds could be under attack and could fall under inheritance tax regimes. Consider a bit more about the inheritance tax and how that could change. At the moment, there's a 325,000 sum that is inheritance tax free on death. Now that's that's been fixed for many years, and it's not likely to change or be indexed anytime soon. However, there are still some concessions which could be tightened up to generate increasing tax revenues in the year to come, and a subtle change that wouldn't affect anybody today unless they died of shock, because it would affect everybody that dies the day after Halloween, budget day, and affect those people going forward or whenever the legislation is put in place. So for example, at the moment there's an additional allowance as a private personal residence relief. So you've got 325,000 personal allowance against inheritance tax for the husband and wife, or the married couple, but then you've got another 350,000 allowance against your main residential property relief to give you potentially £1 million you could hand over inheritance tax free. So it'd be very easy for them to remove that additional 350,000 from the equation, and that would give them another potential 120,000 per dying couple. Another concession that might change is that for a married couple, inheritance tax is only applied on second death. Now, if you wanted to be a tax you wanted to raise taxes and you wanted to bring forward your tax payments, when you take a couple that, an elderly couple, they usually die about the same time. If you look at the statistics of it, they very seldom live that much. When a couple who live together for very, very many years, like magpies, they tend to die within a couple of years of each other. But even so, at the moment, inheritance tax are paid on second death, but if you apply inheritance tax on first death, you give the £325,000 allowance, you could easily tax the inheritance tax before the widow benefits. So you could attack not just pensioners but also widows, and you could get some additional inheritance tax from that. So that might appeal to the Labour Party as a capital tax, not taxing the income of people as they save their wealth, but rather wait till they've collated that wealth and they've got their money in their pockets, and then grab it from them. So inheritance tax changes, there's some potentials we need to look at that. Inheritance tax is based upon your domicile and where you're from. So if you're a British citizen or you've lived in the UK for maybe 15 years or maybe 14 years, depending upon if they change the domicile rules anymore, but effectively you deem domicile in the UK if you've lived in the UK for 15 tax years, or if you're born in the UK, that is inheritance tax is a liability on your worldwide estate. Now you should be able to, you could potentially claim that you're doing a settlement in your country of tax residence, be that Portugal or Cyprus or any other country around the world, but actually each estate should get a tax clearance and it should be exchanged on your worldwide goods. So any footprint of tax you've got for any assets in any country, whether it's your state pension in your home country, a property, an investment, a savings, a bank account, all those give the footprint to allow a digital enabled government to be able to track down and find your estate and charge that inheritance tax. So that could be a much more efficient tax raising exercise in the years ahead. So income taxes, savings taxes and inheritance taxes are up for grabs in the years in the Halloween budget. Let's now look at what could happen with property and stamp duties. Already stamp duties apply on a number of different transactions, but we mainly in the UK pay it on property transactions, and the rates vary and they're quite extensive now. There are some concessions for first-time buyers, etc., but you can pay up to 15% if you're a commercial landlord. We've also seen that local authority bills, local authority council municipal expenses, the councils can now charge private rented landlords more money. So that's a way of increasing their tax revenue for the local authorities now, so that they don't have to get centrally funded revenue. And that's beginning to affect and bite, introduced to manage second homes, holiday homes, and pricing locals out of property. But if that's extended all around the country, it means that all private rental properties are going to face an increased tax bill and tax raising on those private rented landlords, which you're not attacking working people and their incomes, but actually what it means is that in the medium to long term, the private rental prices will go up to pay for the additional tax that you're paying on that local authority bill. The stamp duties could increase the purchase and selling price of properties. That's another potential lag and factor. Capital gains tax is another big interesting challenge. Now for property, residential property, capital gains tax is already more than it would be with an investment. So it could be 10 to 20% on an investment, but it's 18 to 24% depending if you're a high rate taxpayer on residential property. If you own your property through a corporation, then you're just paying you're paying the corporation tax rate between 19 and 25%. So there's a big opportunity to align those there, either just to have two corporation tax rates for the basic rate and a higher rate of 18 and 24 for corporation tax and capital gains tax, or to change the rates so that the 20% is a basic tax rate for a capital gains tax, an income tax, or a corporation tax. So those are potential changes that could come in quite easily with a minimal effect and not impacting working people, but impacting people that are property owners and selling property that is not their own and main residence. The private residence relief on property, by the way, they're guaranteed not to attack. So selling your main home is not going to be a capital gains expense item. We're talking about a second home, a commercial property, or a private residence that's rented out. So all those things are to consider. And for expats living abroad who are renting property out, you have to register as a non-resident landlord to get tax relief at source on the income. So a property agent in the UK has to tax the rental income at source and pay it at source as if it was earned income. To get that relief, you have to register as a non-resident landlord. So it'll be very easy to change those rules so that non-resident landlords have to pay tax at source, and it's not an optional income to be taxed abroad or to be deferred as a pay-as-you-earn tax. Not sure if how much extra revenue that would generate them, but it would potentially generate them, it bring forward the tax payments if it was being paid at source by the property rental agents each month, rather than assessed in the tax return in the 6 months after the end of the next year, so up to 18 months later. So for more information and guidance and help on some of the changes of the Halloween budget and how they might impact you, you can contact us at ProACTpartnership.com. There's also the potential changes with the wealth tax. Now, wealth tax is something that's been talked by the larger governments around the world at the moment. Very few countries have actually got nominal a wealth tax, but some countries have introduced something that's quite similar. So Portugal, for example, have got a solidarity tax that's paid over 80,000 euros a year of income at 2%, and 2%, 1%, 2% has been mooted as a wealth tax. Now it could be taxed on somebody who owns capital above a certain wealth volume, 1 million, 2 million. It could be taxed on any property ownership or any investment ownership at all, or it could be taxed on income as well. So at the moment you have a high rate taxpayer. If you consider their position, once your income starts going over 100,000, you lose your personal allowance. So you could give that personal allowance back to the very high earners if you wished, and then charge them a wealth tax instead. So a 2% wealth tax on 100,000 is going to generate you 2,000 a year, which is just about the personal allowance you've got on 12,500 a year. But if you've got a wealth tax on all income, then it's going to apply not just to earned income, but capital gains, dividends, investments, and everything that might otherwise get a concession or an allowance could end up suffering this 2% health tax. There's also potential for another subtle change. At the moment, there's a separate personal allowance for capital gains, dividends, and interest for different people, and there's other allowances for different issues around the tax system. Now they've been whittled down and reduced quite radically in the last few years. Why not get rid of them? Why not say everybody's got a personal allowance against their income and gains a year of 12,570, but there's no personal allowance against dividends. That used to be 6,000, it's now down to 500. There's no personal allowance for interest. Get rid of that. You pay tax on your interest and your savings. The capital gains tax relief used to be over £12,000 a year, and it's now down to 3,000. So why not get rid of that? and that'll be a subtle way of generating more capital gains, dividend and interest revenue, while still keeping personal allowances, and the PR playbook would say that that's a simplification of the tax system by putting everything under one roof. So there's lots of things to do. How would you manage that? We're talking about individuals and companies and properties that have got a tax liability. At ProACT, we protect family and business, their investments, their property, and their businesses against tax during their lifetime, inheritance tax on death, and the cost and delay of probates and family disputes, by using family trusts and arrangements to protect capital and income across border and down generations. For more information and guidance on some of the ideas we can have to manage your tax, to maximise your tax savings, to do the right thing so that you can avoid penalties and investigations, but pay the minimum tax to protect the family wealth of property, business and investments across border and down generations, you can contact us at ProACT.com. Thanks a lot for listening today. We're looking forward to the Halloween budget. There'll be a few shocks, there'll be a few scares, there may be a few bangs and a few explosions, but in the morning we can wake up and we can start to assess that. There may be action you can take now in terms of protecting your income, protecting your capital. If you fire sale, that's maybe not such a good thing. If you're protecting your assets within a family trust using gift strategies, then you're still protecting the wealth. You're not fire selling it, and you can still take a reasoned long-term planning judgment. So contact us for that information, and we can help and guide you every step of the way. You can contact us at ProACT.com for a free review for new clients, or existing clients can get an advice meeting update and book that online by contacting us at ProACT.com. Thanks a lot for listening. Join us next week where we do a further update and preview on tax come October. Looking forward to winter, looking forward to Halloween, and looking forward to the tax creep that's coming on and how we can protect family and business across border and down generations. Thanks a lot for listening. Bye bye.